Tonight, we're going to switch it up and review the mathematics of cryptocurrency, specifically Bitcoin. And we're going to look at the unit economics of a specific mining machine, such as the S19XP. We'll begin by discussing revenues, then we'll discuss the cost of electricity, and we'll look at depreciation. Ultimately, we will calculate the return on investment, or ROI, of a miner. The questions we're going to attempt to answer are: first, how profitable are these crypto miners at today's Bitcoin prices? Secondly, what factors determine whether an individual miner or a fleet of miners will be profitable? And how do these factors change constantly? And thirdly, we're going to review how these determining factors vary over time to understand the impact that they will have on the unit economics as they change. So what that will mean and what that will mean for profitability ultimately. We're going to begin by looking at revenue from two different perspectives. The first being revenue per terahash per second, and the second being revenue per kilowatt hour. So before we discuss revenue per terahash per second, we first must discuss a concept called the hash price. The formula for hash price is the miner's total daily revenue divided by the global network hash rate. So the hash price is a simple method of determining the expected value of 1 terahash per second of hashing power per day. So it's important to understand that the miner's total daily revenue includes both the Bitcoin block reward and the transaction fees. As of a couple of days ago, the miner's total daily revenue was approximately 27.2 million, and the global network hash rate was 421.9 million terahashes per second per day. Dividing those two into each other, what that means is the hash price was 6.4446 cents per terahash per second per day. In this example, we're going to use Marathon Digital, a publicly traded company. So you can find all of these numbers in their filings on their website or on the SEC website. So to begin, the company's goal is to achieve 23.3 exahash per second of hashing power. That's for the entire fleet. That will probably occur in Q3. So if we know that the revenue per terahash second is 6.4466 cents and apply that to Marathon's fleet, then multiplying the two together, we realize that at the current hash price, Marathon will earn approximately 1.5 million per day in revenue. Now, it's important to understand that the hash price is constantly changing because of a couple of determining factors that we alluded to in the first part of this video. The first one being the global hash rate. It's constantly changing as miners come online or are removed from the network, are either made more productive or made less productive. Also, as electricity costs vary, people will remove miners from the network. Secondly, the network difficulty adjusts approximately every 2 weeks to account for the change in the global network hash rate. And that's to maintain a constant block reward. And thirdly, the price of Bitcoin is changing constantly. And fourth, so are the transaction fees, and that depends on the network activity. So as the miner's daily revenue and the global network hash rate is always changing, so does the hash price. But there is somewhat a more constant variable for a specific company, and that is the company's mining fleet's hashing capacity. So for example, in Marathon's case, they've been rapidly adding tens of thousands of S19XP miners to their fleet. And its hashing capacity, although changing, doesn't change on a day-to-day basis because there's a time lag between when the miners are shipped, when they're installed, and when they're finally up and energized and running. Now, The second method of understanding revenue on a unit economic basis is revenue per kilowatt hour. And because electricity is the key input into Bitcoin mining, we want to understand what our net revenue per kilowatt hour could be. If we have the cost of our electricity, to calculate the revenue per kilowatt hour, we have to apply the hash price to a specific Bitcoin mining machine. And that's because different machines will produce different revenue per kilowatt hour. Taking the S19 XP again as our prime example, the machine has 140 terahashes per second of power at 3.01 kilowatts of electricity. These are the specifications of the machine. So anytime you order a machine, you'll learn the specifications of it. So if we know the hash price and the S19 has 140 terahashes per second of hashing power, then we know that the revenue per machine is $9.22 a day. Pretty basic. Now the S19 XP requires 72.24 kilowatt hours a day, assuming 100% uptime. So putting these two factors together, we get the formula for revenue per kilowatt hour. And it's equal to 9.22 divided by 72.24 gives you 12.49 cents for revenue per kilowatt hour at the current hash price of 6.4446 cents. So revenue per kilowatt hour will constantly change as the hash price changes, whereas the hashing capacity of the mining equipment and the required electricity wattage will be more constant. So these are the two methods of understanding the unit economics of revenue for Bitcoin miners. And now that we've got revenues down, next we're going to look at the cost of electricity and then depreciation. But first, go ahead and like and subscribe to keep your money from rotting in a bank savings account right now, earning maybe 2 or 3% interest, and instead learn to make that money work for you 24/7 right here on Hit the Bid, Learn to Invest. All right, getting back to Bitcoin, let's look at the unit economics of expenses, specifically electricity. It's classified as cost of goods sold on the income statement. And the first step in making the calculation is to discern between the wholesale cost of electricity and the all-in cost of electricity. So some publicly traded mining companies may report the fleet's wholesale cost of electricity. But this is illusory because the all-in cost includes fees and other expenses necessary to procure that electricity. Also, mining companies augment some of their hashing capacity through using hosted sites where the host owns and manages the warehouse. So miners pay additional fees for hosted. So when evaluating the electricity cost, we must account for the all-in cost of electricity plus hosting, which going forward we will define as the total cost of electricity. So that's in terms of per terahash per second basis. On a per kilowatt hour basis, to understand the cost per terahash per second, we must first discuss a concept known as fleet efficiency. So Marathon Digital's management team has reported a fleet of efficiency target of 24.2 watts per terahash. So alert viewers will recall management's goal is to increase the entire fleet hashing power to 23.3 exahash per second. And that is equal to 23.3 million terahash per second. To determine the total required wattage of this fleet, we multiply the fleet efficiency times the total fleet hashing power. That gives us 563.9 million watts or 563.9 thousand kilowatts, since watts are on a per hour basis. we must multiply that number by 24, and the total is 13.533 million kilowatt hours per day for the entire fleet. Now, Marathon and CleanSpark and a couple of other publicly traded miners have reported an all-in electricity plus hosting cost of approximately 6 cents per kilowatt hour. In the case of publicly traded companies, management may provide the total cost of electricity per kilowatt hour for us. So multiplying the daily kilowatt hours times the per kilowatt hour cost, assuming 100% uptime for Marathon Digital, we see that the total cost of electricity is $812,000 per day roughly. Recall, that compares to its revenue per terahash per second for the entire fleet of approximately 1.5 million per day. Now, the second method of evaluating the total cost of electricity on a per unit basis is the total electricity per terahash per second. And the starting point is, again, to determine which specific miner will be evaluated, what that miner's hashing power is, and what the electricity input requirements will be. So recall, for the S19 XP, it hashes at 140 terahashes per second using 3.01 kilowatts per hour. So for a full rotation of the sun, it uses 72.24 kilowatts. At an all-in cost of 6 cents per kilowatt, then the total cost per day is $4.33. Dividing the total cost by 140 terahashes, we see that the cost per terahash is 3.096 cents. So we can just compare this to the revenue per terahash, which is just the hash price of 6.4446 cents. So for each terahash, the net revenue after total electricity cost is 3.3486 cents. So the net revenues in pennies, it's not intuitive. So let's zoom out a little bit and look at these same numbers, but on a per day basis or a per month basis. So daily revenue for Marathon is about 1.5 million, while total electricity cost is about 812,000. That leaves $690,000 per day to cover expenses, taxes, and create a net profit for the owners of the business, which are the investors. So in addition to electricity, however, we must account for the cost of depreciation and the operating expenses. So the easiest method to determine depreciation on a unit economic basis is to read through the company's filings, such as the annual report where they provide it. So for example, in 2021, Marathon's annual report included a comment that the average cost of its machines was approximately $52 per terahash per second. However, in its most recent report, the company did not provide a number. So, the second method of determining the depreciation per terahash per second is just to estimate it. And you estimate it based on the total fleet capacity and the gross cost of all of its miners. So once all the miners have been acquired, the gross cost will be included on the balance sheet, or there will be a note in the financial statements about property, plant, and equipment. That's in the company's filings, such as the 10K and 10Q. So for the remainder of this video, we're going to assume that $52 per terahash per second is still accurate. And finally, we will evaluate the return on investment, the ROI. But when we determine ROI for Bitcoin miners, it's not a percentage. Rather, it's in terms of months to gross profit break even after accounting for the total cost of electricity and depreciation. But it is still before any operating expenses or corporate expenses. So said in another way, we are finding out how many months at the current hash price would the miner need to operate to achieve gross profit break even. So for a S19 XP at Marathon, each machine cost approximately $7,280. based on the $52 per terahash price. But for comparison, on Amazon the other day, one of these sold for around $3,800. So remember these numbers because we're going to use them to calculate ROI. The first step in calculating ROI is to determine the monthly revenue and the monthly total cost of electricity. As we've covered, one method of calculating the monthly revenue would be to multiply the hash price times the terahash per second of the specific miner times 30 days in a month. For an S19 XP at the current hash price of 6.4446 cents times 140 terahashes times 30 days is $270.77. So recall, the monthly all-in cost of electricity and hosting is equal to the all-in cost per kilowatt hour times the miner's required kilowatts times 24 hours times 30 days. So for the S19 XP, the all-in cost is 6 cents per kilowatt hour, and that will have a usage of 3.01 kilowatts required times 24 hours times 30 days in the month. So that's times the 6 cents is $130.03. Monthly revenue minus the monthly total cost of electricity, we will call the net revenue. For the S19 XP, the net revenue is $140.64 per month. Okay, now for the grand finale, the final formula, the ROI, and we answer the question, are Bitcoin miners profitable? The ROI formula is very simple. It is the cost of the miner divided by the monthly net revenue. So if the cost of the S19 XP is $7,280, then the ROI would be 52 months. But at today's cost of $3,800 for the miner, the ROI is only 27 months. So this ROI tells you when the miner will break even, but only on a gross profit basis. It does not include other necessary mining equipment or operating expenses, such as management or other corporate expenses like the accounting department. So ultimately, to achieve GAAP net income, the miners must be able to cover all of these expenses before they become obsolete due to new semiconductor chip technology advancing. So once new technology is introduced to the market, they will make new miners with greater or superior efficiency, and the existing miners will earn lower block rewards. So with your new understanding of calculating the unit economics for a specific miner or a fleet, you can determine how many additional months that miner will need to run to cover all expenses, including operating expenses and other corporate overhead, and still provide an ample return to the investor, to the owner of the business. So ultimately, I think Bitcoin itself can provide a great return, but the publicly traded mining companies will rarely, if ever, achieve net income profitability once all expenses are factored in. The reason I believe this is the pace of technological advancements in semiconductor chips will reduce the net revenue for a miner year after year. And as new competition enters, since there are very low barriers to entry, anyone can go online and just purchase a miner and get it set up. So that by the time all the depreciation and operating expenses are covered, it will be time to replace the entire fleet. So to remain competitive, having said that, the way mining companies can achieve a solid return is by hodling Bitcoin as it rises in price, which we're just starting to see. Personally, I have a hunch Satoshi Nakamoto designed the algorithm with this in mind. Otherwise, a single wealthy individual could accumulate sufficient miners to essentially earn all the rewards from the network, as mining alone provided in that profit, even absent the hodling of Bitcoin. So the pace of technological advancement seems to impede the danger for this sort of centralization, which of course we all know is a direct threat to the values of decentralization. All right, let me know in the comments whether or not you think that in the long term, these miners will be profitable on a net income basis, and whether or not you see large publicly traded mining companies posing a potential threat to the primary principle of decentralization.